Good morning, folks. Happy Friday. We are looking at a chart of the yield on the 1-year Treasury bill. And the chart that we normally look at for interest rates is TNX. That's yield on the 10-year note. And I hadn't looked at shorter time durations until just Wednesday. And I looked at this chart and I thought, holy cow, that's a parabolic curve. I feel like I've been remiss in not paying attention to the short end of the yield curve, because clearly there's a lot going on there. That was Wednesday. That was the day that I looked at this chart. I'm like, holy cow. And as we can see, the parabolic move to the upside continues. I suggest that paying attention to the short end of the yield curve is important right now. Let's look at a couple of more Treasury bonds. Here's the 2-year note, same story. Parabolic rise. This is back September of 21. So we're on, what's that, 6 months, going on 5-6 months, where we've had this steady, steep increase in interest rates in the short time frames. Here's the 5-year note. What really catches my eye here is the long tail on both of those bars, and it's suggestive to me of high energy. This is a market waiting to make its next move, and in all likelihood that move is going to be higher and potentially dramatically higher, or impulsively higher. That's probably a better way of saying that. I'm expecting an impulsive move higher in the 5-year rate, that basically the 5-year chart is moving to look like this and look like this. We're not seeing that kind of action yet in the 10-year note. Like I said, I only noticed this chart on Wednesday, and I am still digesting what's happening here. And of course, it dovetails in with one of my main operating premises at this point in time, and that is that interest rates are heading dramatically higher, and it's the markets moving rates higher. It is not the Fed moving rates by choice. And again, just my opinion. This is not the Fed doing this by choice. This is the market moving rates higher, and doing so dramatically in the short time frame. This is gold in the daily time frame. Obviously, gold is reacting to two significant headwinds right now. It's the rising interest rates. As an investor, you look at gold, which pays no interest, and you look at Treasury bonds, which are starting to pay some interest, and maybe you decide, hey, I'm going to sell my gold and move it back into interest-bearing instruments at this point, try to make some yield, make some money. That's part of the selling that we're seeing in gold. And then we also have a strong rally in the US dollar right now. So two significant headwinds for gold at this point. We can see, obviously, impulsive correction down to, so far, the lower median line of this shift pitchfork, potential for support at that level, although it would appear that gold this morning is testing that level and trying to push below it. As a next potential support level, we have this prior low. We'll see whether that can hold. MACD still in bull mode, but on a fresh sell signal after this price action, energy low and declining. Silver, same thing, not a happy camper, obviously pushing lower down into the support resistance area. Got a potential for support down at the lower median line of this shift pitchfork, which is coincident with the bottom of this support resistance zone. So obviously silver getting beaten bloody. MACD sell signal, although MACD is still in bull mode, suggesting that the primary trend is up. Now, I bought silver one day this week, and obviously I'm wishing that I had waited, but part of my philosophy on physical silver right now is that there is a limited supply, and I know how much silver I want in my portfolio, and I have an acquisition plan for getting there. I'm buying silver, and price is not my primary consideration for when I buy. So tomorrow, one of the coin shops that I go to is open on Saturday. So I will most likely be making an additional purchase of physical silver tomorrow and will enjoy the lower price. So there's silver in the daily time frame. Nothing exciting to look at there. Mining stocks, as represented by GDXJ, the junior miners ETF down to the support resistance level yesterday. They're following the metals lower. As we stated, here's the US dollar. This is one of the things that the precious metals are reacting to this week is strength in the US dollar. And I'm guessing that somehow financial markets investors are interpreting recent bloviations from the US Fed as being dollar positive, US economy positive, and the precious metals negative. So I don't pay I pay attention, but I don't believe anything the US Fed says. They only have two tools in their toolkit at this point. Blarney is the first one, bullshit, hot air. That's what we get, pretty much every week. We get 2, 3, 4, sometimes 5 of the talking heads from the US Fed system bloviating at us, blowing hot air at us. We're going to taper. We're going to raise rates. Oh, no, we're not going to. We changed our minds. Oh, the dot plot. And, it's just silliness. Kind of amusing to watch. Watch from a distance that investors get blown all over the place, lose all kinds of money because they pay attention to what the US Fed blows out their mouths. So anyway, enough of my ranting. This is the dollar in the daily time frame, and we can see that it has pushed impulsively up through this. This is a prior high from a higher time frame and continuing to push higher this morning. So dollar clearly trying to rally higher, go challenge the 98 level. If we can break higher here, 98, the round number, will be our next target. MACD has moved up into bull mode, suggesting uptrend, suggesting that the primary trend is upwards. Energy obviously very elevated and climbing sharply. So a lot of strength in the US dollar right now. Here is the yield on the 10-year note in the weekly time frame. We can see big impulsive move, kind of a high consolidation at this point, getting ready to push up and test the 2% level. So a lot of movement in the interest rates. TNX in the daily time frame, and again, just kind of a sideways bumping in the daily time frame, but clearly trying to move higher. So MACD very overbought, perhaps about to give us a sell signal, energy elevated. So we looked at the charts of the 1, 2, and 5-year Treasury notes. Here's Bitcoin trying to stage a rally, but just not making it. That movement on Wednesday, I would suggest, was a counter trend, just basically a rally back up to test resistance from below and a roll-off, a subsequent roll-off. Not enough energy to rally, rolling back over. Consolidation, sideways bumping, however you want to look at that. Doggy coin, this is Elon's current baby. He's suggesting that McDonald's should start accepting doggy coin as payment for Big Macs or whatever it is McDonald's sells. I don't eat there because they don't sell food. When McDonald's starts selling food, I'll think about eating there. Here in doggy coin, we can see price has broken below this last potential support level, currently testing that level from below as resistance, moving averages in negative alignment. MACD in bear mode, energy very low. Nothing to get excited about in doggy coin. So equity markets haven't been happy. SPX in the daily time frame. Look at the volatility there, folks. I mean, these big wicks on these candles, this is indicative of elevated energy. The way I think of these long wicks, these are battles. These are investors, the bulls and the bears, duking it out in the financial markets and seeing which direction they're going to take price. This was the plunge protection team stepping into action, trying to put a bottom under this collapsing market. And if you don't believe that the plunge protection team exists, go back to 1987, do a little bit of research. It won't take you 5 minutes. It's the President's Working Group on Financial Markets, I think they called it, affectionately known as the Plunge Protection Team. And there's more than one government organization that tries to put the bottom under the collapsing financial markets. Anyway, call it conspiracy theory, but go do your research before you start touting conspiracy theory. Anyway, daily time frame, equities aren't looking happy. MACD in bear mode on a sell signal, energy very low, price action all below the moving averages at this point. Sideways consolidation, not great action in the equity markets right now. Same thing in the Dow, and even more to my eye, the volatility in the Dow is even more dramatic than in the SPX. I mean, look at the tails on these candles, just crazy. Very glad that I don't have any of my money invested in the equity markets, other than mining stocks. That's my one weakness for the casino, which stock markets have become in recent decades. I was reviewing a little bit this week on how the headline equity averages are maintained. The methodology for calculating the Dow Jones in particular, when the price of a stock is rising, that particular stock is given extra weighting in the moving average. And when a stock is falling, that particular stock loses weighting in the moving average. It's almost like, if you were going to set up a average with the intention of giving the most bullish possible picture to equity markets, you would probably come up with something that looked about like the Dow Jones Industrial Average. Go look at the methodology for calculating this one in particular. I think you'll find it interesting, but I'm a geek, so what do I know? Here's the NASDAQ daily time frame. Again, not happy. Tech stocks, they're fighting the same headwind as gold, precious metals, rising interest rates. The tech stocks not happy when interest rates are rising. Again, stick safe, plunge protection team, and albeit their efforts basically wasted money because the market has continued to roll over. So nothing happy in the equity markets. In my quick skim of reading material this morning, this is an article. This is Jeremy Grantham. He's a famous investor, has done quite well in his career. He is 83, I believe, at this point. What he is talking about is a super bubble. So he's talking about bubbles in the financial markets. And Mr. Grantham, his key philosophy, if you want to look at it that way, is reversion to the mean. And I suspect that that is what he is talking about in this article. I'm yet to read it. As soon as I finish this video and get it posted, I'm going to go read his article. In my study of financial bubbles, they've happened throughout history. Tulip bubble, John Law and his scheme. There have been numerous financial bubbles in the last several hundred years. They've all ended the same way. Financial bubbles, and this is a truism because it happens every time, financial bubbles fully retrace back to their starting point and tend to overshoot in the opposite direction. So in the case of the stock markets, they will at some point retrace all of their bubble territory and most likely overshoot to the downside. And so when you see people talking about a target of 5,000 for the Dow or 3,000 for the Dow, that's what they are referring to. It's reversion to the mean. And so I suspect that that's what Mr. Grantham is talking about in this article. I suggest that you read it. I'll give you an update in this weekend's video. Folks, I'm going to leave you at this point, and Go read this article and see what the markets are going to give us today. Have a fantastic day and weekend. Talk to you soon.